I think the first thing is that so I like to go through this chart, and actually I shared it recently when I wrote an article. If why we need to be really long-term investors. First, I want to go through why we need to be long-term investors, then go back to this, right? So if you're investing and owning a stock for one day, you have about a 50% chance of making money or losing money. But if you're holding that for 1 year, that increases to about 60%. So slightly above, more better than a coin toss, right? Because markets tend to go up over the long run. But when you actually try to hold a stock for more than 10 years, it increases significantly to about 80%. And when you hold something for more than 20 or 30 years, there's almost 100% chance you make money, right? So this is the stock index, using the stock index as an example. So really, that's the reason why we need to be looking at long term. Now, there's going to be a lot of noise, and the way to do it noise is that we need to firstly try to step ourselves out of it, and to give it the context, right? If the market is if the US, for example, stock market, for example, opens at 10:30 or 9:30, on tonight, for example, and if every half an hour you're going to look at the stock price, you are going to be affected by it. Okay, no matter how good you are, no matter how immune you are going to be affected by it. So what we do is that, one, we don't look at the stock price when it's market trading. We only look at it when the market closes. So for example, I look at it daily, yes, but I only look at it, for example, at 5:30 when I wake up, when the market is already closed and there's nothing I can do. Before that, I'm not looking at it. After that, I'm not looking at it, because before that, it's going to be the same as the previous morning, right? So I'm really not going to look at it. And in between, I'm sleeping. So I sleep very well and I don't have to worry. So firstly, change your mindset, change your habits to not look at it daily. You better still, you can look at it, say, weekly, right? So I think that's the first thing, right? There's no point you looking at stock market returns and trying, I've made $1,000 more, $100 more, $10,000 more. It really doesn't matter, right? You know the companies that are doing, right? Mr. Market will mark the prices of your stocks and will keep giving you prices every second, every hour, and every day, but you don't really care. You need to focus on the business, and the business, to be honest, if you are doing in the US, they report quarterly. They report 4 times a year. You want to look at numbers, those are the 4 quarterly numbers you should be looking at, the earnings report. Do not look at the price chart, because I can tell you, and this is what I've come to realize, and I wrote in my book as well, which is this. Over the long run, when you have rising revenues, rising profits, and rising cash flows, you will have rising stock prices. I'm going to say that again, right? When you have rising revenues, profits, and cash flows, you will have rising stock prices or market caps. It is just what it's going to be, right? Look at any company that does that over 10 years and more, you will see that similar trend. If the revenues are falling, the profits are falling, the cash flows are falling, you will naturally have a lower stock price. That's just what it is, because the companies are making money, they're generating value, and hence, as a result, their returns are higher, right? Obviously, Mr. Market is where it comes in. The valuations can be up or down, and that's generate a lot of things. So if you look about it, if you're investing in the near term, in the 1 year, valuations tend to account anywhere from 60 to 80% of the returns. So for example, last year, a lot of the companies, if you had made money, you will probably have made money only owning energy companies. Because energy companies were the only one making money, right? The only one making earnings with positive growth. But the reason why they're making a lot of earnings grow was because the year before, energy price was very low and they were all losing lots of money. So they're not making a lot of money, and that's why their growth year on year, because of an easy base, seems outsized, right? So the valuations of all our stocks came down because revenues were just a bit more softer from the standpoint. So whereas you look at the long term, right, it's really the revenues and the cash flows and profits that account close to about 90% of that explains really stock returns. And that's really truly the holy grail of investing, and knowing what is actually the real driver of stock market returns, right? Which is those 3 things that I mentioned.